What if I told you that the stock market was never designed to make you rich? Every year, millions of beginners enter the stock market believing the same thing. If I just buy the right stock, I'll be financially free. Some succeed, many fail. Most never understand why. Today's mystery is simple, but powerful. Why does the stock market reward patience, but punish impatience? Why does history keep proving this again and again? To answer that, we must go back in time long before apps, charts, and influencers. Back to where this system truly began. The stock market did not start with computers. It did not start with banks. It started with ships. The early 1600s, global trade was dangerous and expensive. Ships left Europe for Asia and sometimes never came back. If a ship sank, the trader lost everything. One company changed everything. The Dutch East India Company. Instead of one person taking all the risk, they divided ownership into small parts called shares. Anyone could buy a piece. If the ship returned safely, everyone shared the profit. If it failed, everyone shared the loss. This single idea created something new: shared risk, shared reward. That idea became the foundation of the stock market. But here's the twist: most beginners never hear. From day one, the stock market was about long-term ownership, not fast money. Yet humans are impatient, and that impatience would soon reshape the market. As more people began trading shares, prices started moving. Not based on business value, it's on emotions. The first major example came in the 1630s with tulip mania in the Netherlands. Tulip bulbs became more valuable than houses. People borrowed money to buy them. Why? Maybe because prices were going up. Then one day they stopped. The result? Prices collapsed. Fortunes disappeared overnight. This pattern, excitement, greed, panic, collapse, became a repeating cycle in market history. And it taught the first painful lesson. When price rises faster than value, the fall is always brutal. But humanity did not learn. We never do the first time. Fast forward to the 1800s and 1900s, industries grew. Railroads, steel, oil, and factories needed money to expand. Stocks became a way for companies to raise capital and for investors to grow wealth. This time, the system worked until greed took over again. In the 1920s, the US stock market exploded upward. People bought stocks on borrowed money. Everyone believed prices could only go up. Sound familiar? In 1929, the market crashed. The Great Depression followed. Banks failed. Jobs vanished. Lives were destroyed. Cause and effect were clear. Easy money led to speculation. Speculation inflated prices. Reality crashed the illusion. The stock market did not fail. This is important for beginners to understand. The market is a mirror. It reflects fear and greed. Now let's jump to today. The stock market is no longer physical. It lives on screens. Anyone with a phone can trade in seconds. The speed feels powerful, but it is dangerous. Here's shocking data. Most traders lose money over time. Majority of market gains come from a small number of days, yet beginners are told to trade daily, time the market, and act fast. Why? Because fear spreads faster than truth. The system still rewards what it always has: patience, ownership, discipline, and it punishes emotion, overconfidence, short-term thinking. The tools changed. Human behavior did not. Here is the answer many beginners wait for. Why does the stock market rise in the long run? Because businesses grow, companies innovate, produce goods, they increase efficiency, they raise prices, they earn profits. Those profits raise stock value. Over decades, this compounding effect becomes powerful. But in the short term, anything can happen. News, wars, interest rates, politics, panic. Short-term movement is noise, long-term movement is progress. This is the core truth beginners must understand. Look at recent history. The 2008 financial crisis, 2020 market crash. Different causes, same pattern. Fear crashes markets, time heals them. Each time people said, this time is different. Each time, it wasn't. Markets fell, markets recovered, markets moved higher. It's not because of luck, but because human progress continued. Most beginners ask the wrong question. They ask, which stock should I buy? The better question is, why am I investing at all? The stock market is not a casino. It is a long-term ownership system. Those who treat it like gambling become stories. Those who treat it like ownership build wealth quietly. Stock market is not complicated, but it becomes expensive for those who ignore these 3 points. 1. The stock market is a tool, not a shortcut. It rewards time, not speed. The longer you stay invested, the more powerful it becomes. 2. Emotions are the real risk. Fear makes people sell low. Greed makes people buy high. Discipline protects you. 3. History repeats because human behavior repeats. Learn from past crashes. They are not warnings of failure, they are lessons in patience. Here is the warning every beginner must hear. The stock market does not care about your hopes, needs, or deadlines. It will test you when prices fall. It will tempt you when prices rise. The question is not whether markets will crash again. The real question is, will you panic, or will you understand what is happening? If you want to truly understand the stock market, start by respecting it, not fearing it. If this video helped you see the stock market differently, like, subscribe, and stay with us, because the market rewards those who stay long enough to learn its lessons.